Futures this morning are a little bit positive after a down session yesterday. Joining us now, Megan Horneman, Chief Investment Officer at Verdence Capital Advisors. I don't know if you've followed suit, but there are some interesting things happening, Megan, among Wall Street soothsayers. One of my favorite is when you have at a 5,500 S&P target, and suddenly the S&P's at whatever 6,000, and you raise your target right to where the S&P is because you've been so wrong, and expect people to forget where you were. Have you had a target?
Well, not necessarily. We haven't. We've been looking at the S&P 500, but we haven't put a specific target on it for year end. We've looked at the earnings side of it because that's been the biggest thing that's been changing this year, and that's the biggest thing that's going to drive the S&P 500. So it's really dependent on what we see from the earnings perspective going forward in the second half of this year. Our biggest concern is we haven't seen much downward revisions for the rest of this year or even next year that would really warrant changing our expectation for the equity market for the rest of this year.
How surprised were you by the sharp snapback from the April lows, the Liberation Day lows?
The market tends to swing one way or the other. So the surprise rebound when that negative headlines came off the table wasn't really a big surprise to us. Let's put this in perspective. The Trump administration came out with a worst case scenario on tariffs. So yes, the market's going to react to that, but then there's really only one way to go, and that's for positive news to come out. So when you get that big bounce back, when you're not getting the worst case scenario, that wasn't a big surprise to us. The fact that the market continues to hit record highs when there hasn't really been a solution from the tariff perspective, that's a little bit more surprising and has us a bit cautious going into the second half of this year.
My biggest concerns are inflation and debt, which I guess the biggest concern for inflation should have been when we were headed to 40-year highs, I guess. Debt has been growing. Is it qualitatively different than, let's say, a couple of years ago? Has it gotten worse, both of those things, or you're worried about it getting worse?
Well, worried about it getting worse, but I do think it's gotten worse. And it's not just a U.S. problem. This is a global problem. So when you look at whether it's debt percent of GDP, you're looking at a lot of these developed economies running well over 100%. And this is concerning for the long term. We are concerned from the economic standpoint from the long term. But the short term, when you mentioned inflation, that is something that kind of keeps us up at night. Inflation keeps getting kicked back. So the Fed has made it very clear we don't know what the tariff implications going to be, so we're going to stay on hold. But the market's expecting the Fed to cut interest rates in September and December, and that was our base case scenario. But now that we're looking for the tariffs to be pushed back to August, remember, those effects on inflation won't be seen now. That just keeps getting pushed out into the second half of this year. So can the Fed really cut interest rates in September? They won't know in September what the impact's going to be. So now that September rate cut, in our opinion, is getting a little less clear.
That's looking at the inflation side of things. That's why this is such a Rubik's Cube to try to figure out, because if the tariffs are implemented and there isn't another lessening of the trade war, that's very tough for the economy, which would warrant a rate cut to get out in front of. So how do you know which demon to worry more about? I'm more and you make the case for how growth could slow, the labor market could slow. We're seeing some signs of cracks in the consumer. Why focus on the inflationary side of things instead of what's very likely to be a slowing economy? And we're much higher. We're still restrictive. We're much higher than the rest of the world.
Mm-hmm. So I'm not a Fed official, I'll be honest with that. But in my opinion, the Fed's going to take whatever is the furthest away from their target. So right now, the labor market is showing signs of cracking, but it's not completely imploding. But when you look at inflation, that really is the unknown for them. So they can model and look at the unemployment rate. But when it comes to inflation, they can't model anything if we don't know what the tariff impact is going to be, and then what the businesses are going to ultimately ultimately pass on to the consumer. That's something they just have to wait and see. And let's be honest, they've told us that they're going to do that. So what's changing? What's changed in that perspective? The fact that they've kicked the tariffs back another month, that just pushes the Fed back possibly another month on when they can see this impact. So unless they completely change their tune, I think that this September rate cut is, as I mentioned, this is a 50-50 chance right now. We're just going to have to wait and see from the data standpoint.